With home prices going absolutely nuts over the last couple of years, home equity, the amount of money that you have in your properties, is reaching all-time highs across the country. And at the same time, we are seeing interest rates at all-time lows. And if you put these two things together, it creates this scenario where almost everyone is considering a refinance. But refinancing is not always the right solution for everyone. So today we're going to review some simple metrics that will help you determine if and when you should refinance. By the end of this quick video, you're going to be able to tell without any doubt if refinancing will help you boost your investing returns or not. What's going on, everyone? I'm Dave Meyer from BiggerPockets. Thank you all for joining me today. If this is your first time watching, each week I break down economic and real estate news to help investors meet their financial goals. This week, we're talking about a super important and useful tool, the cash out refinance. But before we jump into it, make sure to subscribe to the BiggerPockets YouTube channel and follow me on Instagram at the Data Deli to get even more investor news and information. And with that, let's get into this big question. And just to remind you, the question is, with interest rates so low and equity so high, should I refinance my properties? And to answer this question, we're going to do 3 quick calculations. And at the end of this, you'll be able to tell if refinancing will benefit your business. And don't worry, the calculations are super easy. I'm going to walk you through all of it. The first is to calculate the equity you have in your properties. The second is to calculate your return on equity, also known as ROE. And the third is to calculate your potential ROE after a refinance. And again, all of this is super easy. I'm going to walk you through it right now. I'm going to use a virtual whiteboard here so you can follow along with everything that I'm doing. But please just bear with me because this is the first time we're doing this on camera and there might be some kinks to work out. But here we go. In this example, we are going to look at a property purchase of $300,000, and we're going to say that we put 20% down on that property, and it has cash flow of 15 grand. And now we said the first thing that we need to do today is measure equity. And what equity really means is the value of the property to you, the investor, if you went to sell that property. So you sell the property, you pay off the loan and any other financial obligation, and what is left over is your equity. So in this example, our property value, as we said, was $300,000. And we are assuming that we put 20% down. So to figure out what your loan balance is, you take the opposite of the 20%. You are getting a loan for 80% of your property value. And so all you need to do right there is 0.8, 80% times 300K, and that equals 240K, right? So we know that that's our loan balance. So our loan balance we'll put in here is $240,000. And as you can see up here where this equation is, equity, all you have to do is take the property value minus your liabilities. That's all your financial obligations. But in this example, we're going to keep it simple and say that our loan, our mortgage, is our really only financial liability. So all I need to do is add a little subtraction mark here and take 300,000 and subtract that 240,000, our loan balance, and that's going to give us our equity of $60,000, right? All right, that was super easy. Now, it's important to know that at the beginning of your purchase, when you first purchase, which is what we're simulating right here, your equity is equal to your down payment. So if you wanted to calculate your down payment over here, we would just take our 300K, right, at times 0.2 to get our down payment, and that equals 60K as well. So you can see that our equity is equal to our down payment. And so that's pretty easy, right? Hopefully you should all be able to do this for any property that you are about to purchase. But what happens in year 5? So in this example, we're going to say 5 years from now, you want to figure out what your equity is. Luckily for you, in this example, I'm hooking you up. Your property now went to $400,000. And so that is great. You've made a lot of money. Your loan balance, because you've been paying down your loan over the last couple of years, actually goes down to $220,000. And so your equity, again, all you got to do is subtract this 220 from 400, and now your equity is worth 180K. Congratulations, your equity has tripled in 3 years. That's wonderful. So that is a lot of equity you have, but you have to think about what this means. Rather than just having 60K invested into your deal, you now have 180K invested into the deal. Because if you went to sell that property, you would have 180 grand in cash you can invest anywhere you want. So you have to think of that as money that you could be investing elsewhere. So you need to track how well your equity is generating your cash flow. And that's where step number 2 comes in, which is return on equity. So we're going to jump down here and calculate our return on equity. And up here, where highlighted in yellow, you can see the return on equity equation, super easy. All you have to do is take your cash flow and divide it by equity. I've already told you what our cash flow in year 0 was. It was at $15,000. And we've already calculated our equity at 60 grand. So I'll just write this back in, 300K. Our loan balance was 240K. Our cash flow, 15K. And equity, 60K. So to calculate ROE, like we said, cash flow, which is equals 15K, divided by our equity, which is 60K. And that means our return on equity in year 0 is 25%. That's really good. Return on equity, just for the record, you'd be doing really well if you got that. So that is pretty easy. But what happens in year 5? Again, is our ROE going to go up or down? We want to understand this because ROE is a measurement of how efficiently your money is making you more money, how efficiently you are generating cash flow given the money you put into it. So again, our property value, remember, was 400K here. Our loan balance was now 220. Our cash flow, let's say it goes up to 20K per year because after 5 years, you've been able to raise rent. And remember that your equity was now 180K. So your ROE equals now 20K divided by 180. So our ROE is actually now just 11%. And so it's not necessarily good or bad. Like your ROE is lower, but honestly, that's okay because it means that you've made a lot of money. Your cash flow and equity are both up. You're making 20K in cash flow instead of 15K, and your equity has tripled from 60 to 180 grand. So no one is complaining that your ROE is going down, but it means that you are not earning cash flow as efficiently as possible. There are 2 ways to restore ROE. You could either sell the property or you can refinance and do a cash out refi. Now, selling is the easy one. Could you find a property with a higher ROE than your current prop? Then you might want to sell and invest at a higher ROE if cash flow is your main objective. But before you do that, you should consider refinancing because that is such a valuable tool to investors. It could allow you to keep your existing property and boost your return on equity at the same time. Okay, so let's look at what a cash out refi would actually do for you, the investor. Now, a refinance means that you're basically getting a new loan. You're starting over on your mortgage. And because you're an investor, let's assume that you need to keep 25% in the deal. This is basically a new down payment. You put 20% down before, but since you're refinancing, you're an investor loan, you're going to have to put 25% equity down to get 75% loan. So we know our property value is 400K in year 5, and we know that our down payment is going to be $100,000. Now we know that our loan balance, we're going to get the next 75% that we need to pay for the property in a loan, and that's going to be 300K. And that means our equity, again, is 100K, because as we said, in year 0, your equity is equal to your down payment. And because we're starting the mortgage over, we're basically at year 0 again, and our equity is 100K. But if you were thinking, I had 180K in equity, and now I only have 100K in equity, what is going on here? It's a great question. And the answer is delightful because you get that 80K in cash. That's right. You had 180 grand, right? And you're only keeping 100 grand in the deal. So you might subtract 100K, and that means you get 80 grand to bring home and do whatever you want with. You had 180 grand in equity, you're keeping 100 into the deal, and you get 80 grand to do with whatever you want. So let's look at the 2 things that this cash out refinance does for us. First, it allows us to reset our ROE. So we have to assume that our cash flow after refinance is going to decline a little bit because you're taking out a mortgage on a more expensive property. So instead of having 20 grand in cash flow like we did above, we're going to assume that we have 18 grand in cash flow and our equity is now 100 grand. So we know that ROE again is cash flow divided by equity. Our cash flow is 18K. Our equity is 100K. And so our ROE is simple. It equals 18%. So it is not as high as it was. At the beginning of year zero, our actual year of purchase, we had an ROE of 25%, but we were down to 11% in year 5. And so by doing the cash out refinance, we have boosted our returns. We are more efficient in using our equity to generate cash flow because we are now up to 18%. And secondly, we now have 80K to do with whatever we want. And let's assume that you are able to go out and buy a new property using your 80 grand in equity to get something that generates an ROE of 18, 20, maybe even 25% like you got on your first deal. So hopefully you can see how valuable this is to investors. You can reset your return on equity, therefore making cash flow more efficiently, and you can take out money for a new investment. And in the process, you are ensuring that you are making cash flow as efficiently as possible. So go do this right now. If you have a rental property, go calculate your equity and your return on equity and determine if a cash out refi could help you generate more cash flow in a more efficient way. And when you've done it, I would love to hear what you find in the comments below. All right, everyone, that is it for me today. I hope this new whiteboard style of video is helpful to you all. Please let me know in the comments what you think, if I should keep doing more stuff like this. I'm Dave Meyer with BiggerPockets, and you can always hit me up on BiggerPockets or at the Data Deli on Instagram, and I will see you guys all next week. Thanks.